Sivaramakrishnan Ganapathi, Managing Director of Gokaldas Exports, joins us, and this is a time when we want to understand that what is happening to the export market, given that the developed market economies are doing much better. The China One policy is at play. Even the rupee has not been on the right side, and the inflation in fabric prices, yarn prices have been on the wrong side. How exactly is the export-dominated business, garment business or garment export business moving? Mr. Ganapathi, good morning. Thank you for joining us. Let me first understand the big picture. When we spoke to you last time, you were quite optimistic. Has that optimism translated into more business, better outlook, now that things are looking much better, at least in the developed markets like Europe and US?
Certainly. If you look at the developed markets, both United States in particular and Europe as well, they've started opening up their economies with vaccination having reached a certain critical mass. And more people are going out and buying garments, enjoying themselves, going to restaurants, meeting people. So obviously the demand for garments and such products has gone up. So that's good news for us because most of the stores in the States as well as online media are selling a lot of their products, and they are planning to stock up their inventory. Good news for manufacturers like us, because then we will get an opportunity to produce more to help drive the consumption. So international markets on which we are dependent on almost solely is doing well, which in turn leads to good order books and demand situation for us.
Great. Now let's understand the volatility part, which is that yarn prices, fabric prices, everything has gone higher, and rupee also has not been on the right side of an exporter. So what happens because of factors which are beyond your control? I mean, you cannot do anything when fabric prices and yarn prices are going higher or currency is not moving. But you'll have to come up with a strategy. How are you managing it?
Certainly. So when we are converters, so we buy fabrics from the market and then convert it into garments. So our core skill lies in producing high quality, complex garments, and consistently do that, as well as design those garments and produce them. So from our standpoint, when we take an order, we tend to go back and book the fabrics. We tend to cover the fabric prices in our pricing. So by and large, it is passed through. We are also a large, supplier, which means we are also a large buyer of fabric. So we do have the power to buy at a good price, and whatever increase to the best extent possible, we try to pass it on to our customers. Otherwise, to a smaller extent, we may have to absorb in our efficiencies, but by and large, we have been reasonably able to pass on the input costs back to our buyers. As far as Forex is concerned, Forex volatility is always there in the market. We tend to hedge well ahead into the future. So we have hedged ourselves well into FY22. So we don't see too much of a problem from a short-term volatility. But if rupee remains strong, then that will not be great for us, because it has got its own impact on our costs. But then by and large, we tend to push back on the rupee as well to our customers. But a weakening rupee is always good for exporters. So we're hoping that in the long run, the trend of rupee weakening will continue.
What has been the big difference in your receivables and your total order cycles because of lockdown and external factors? Because the lead time in a business like yours is very important, so that you don't miss the spring season or you don't miss the winter season. What is happening to the lead time, the receivables, and other aspects of the supply chain?
Sure. So from a fast fashion perspective, so those fast fashion customers are constantly looking at reducing the lead times. We have to gear ourselves up in terms of raw material procurement as well as manufacturing timelines to see if we can cut it shorter and shorter, so that we are able to meet the fast fashion timelines that they are constantly working on. So reduced lead time puts a lot of pressure on our manufacturing capability, manufacturing capacity, as multiple products have to be scheduled at the same time. But then we are gearing ourselves up for it. We are more or less in sync with our customers to satisfy that. As far as receivables go, we don't seem to have a problem with that. Most of the international customers are very prompt in paying as per the payment schedules, and we don't have too much of a problem with receivables. When COVID hit their markets, we did have some amount of realignment of payment terms, but more or less we are coming back to normalcy on that as well, by and large. So I don't foresee any problems from a receivables perspective at the moment. Lead times, however, for fast fashion customers are shrinking, and we are coping with it. We're managing it.
Okay. In terms of prices as well, cotton prices have been moving higher. How's that impacted operating costs, margins as well? And yarn prices as well. What's the outlook on that front, and how are some of these impacting operations?
Sure. So yarn prices have gone up for various reasons. There is a cyclicality in that business. Moreover, the banning of Uyghur cotton in China, Xinjiang cotton in China, due to the Uyghur problem, has also resulted in demand for Indian yarn and Indian cotton going up. So there has been a upward trend in prices of inputs for us. But then that's global, and customers of ours will have to factor that in, and we will tend to push it back on our customers when we buy raw materials which are cotton intense. So that's how we manage the business. We try to make it as much as possible a pass through for us.
Okay, so trying to make sure that one can pass it through. Also, in terms of client additions, have you gained market share? What have we looked at in terms of client additions, particularly as we see people looking for alternatives to China? How has the response been on that front?
Sure. So we've been growing with our existing customers very well, and we've been onboarding new customers as well. So in the last 3 years, we have onboarded at least 8 or 9 new customers, and that trend slowed down a bit during COVID, because a new customer will have to come and audit our factories for compliance and then sign off on us, and that hasn't happened over the last 1 year because of travel restrictions. But I'm hoping that once the travel restrictions get lifted sometime down the year, maybe we will resume adding new customers as well. But then we've added quite a few of them over the last several years, and we are happily growing with them. The opportunities to grow with our existing customers is also reasonably good, and we are not shying away from taking up those opportunities too. So that's going on well. As far as China Plus One, your question regarding that, there have been several opportunities that have come our way where goods were being made in China, and we have taken up those opportunities as well. So that migration of garment production from China to other countries continues, and good operators like us, people who are able to consistently deliver, will always benefit from that strategic move.
Customers, but we also know that a lot of big retailers in US, which have been big buyers from America, either they've gone belly up or they are no longer the formidable forces to be. JCPenney, Macy's, Gap, Bloomingdale's, these were the stars earlier. Now some of them don't exist, and the relevance has reduced. So are you able to make up for the loss from your traditional customers?
So we have, we have several customers, and many of them are very, very large, or most of them are very, very large. And our share of, customers' wallet is also not that big that, we become a dominant part of them, and then whatever happens to our customer does tend to come back and impact our financial well-being. So that isn't the case. We've had some situations. For example, we used to have Sears as a customer till about 2 years ago, and they went belly up and went through bankruptcy. We had to write off certain receivables. Likewise, we had to write off a very small portion of receivables when JCPenney went bankrupt. But now they've come back under a new financing arrangement and a new management, and they seem to be doing well and picking up. Gap seems to be turning around the corner, particularly their Old Navy brand seems to be doing okay now, and they are coming back up strongly. Almost all of our customers that we have currently are now strong and are bouncing back after COVID. The overall strong retail market is certainly helping our cause, where most of our customers seem to be picking up their shares and picking and seeing growth for themselves. So which is good for us. The weaker customers have been whittled out over the last 1 year. So what is left will only grow going forward.
Okay, you've deferred the capex plan, because of uncertainties in the COVID scenario. Given the kind of uptick now, can we look at capex in FY22?
So certainly between FY22 and FY23, we are planning additional factories as we speak. We are bringing up a factory in Tumkur, which should go online in about a month or two. We're waiting for the lockdowns to be lifted in Karnataka so that we can get started on that work. And we're also looking at an additional factory in north of India. So we are looking at multiple options to expand our capacity. And for that, we will be investing in new factories. Absolutely.
All right, great. Thanks so much for joining us this morning and taking us through the latest there at Gokaldas Exports, Mr. Ganapathi.